Welcome to Talks with Dr. Gupta and Friends. It's Sunday, February 1st, 2026. A sacred Indian morning. Chai in hand, cricket on TV, markets closed, nerves calm. Except this time, the calendar was torn up. Parliament was in session. Markets were forced open. And within minutes of the finance minister speaking, the calm shattered. The Sensex plunged nearly 1,1600 points at its worst. By the end of the day, almost rupees 8 lakh crore of investor wealth had vanished. No dramatic tax changes, no headline giveaways. Yet the market reacted like it had seen something deeply unsettling. This wasn't panic over words. It was fear of what the numbers implied. And that's why this budget matters. Not for what it said loudly, but for what it admitted quietly. The immediate spark was clear. A sharp hike in securities transaction tax, STT. On futures, costs jumped by over 50%. On options, margins were crushed overnight. For high-volume traders and institutional investors, these tiny percentages were fatal. Liquidity evaporated, foreign investors pulled out, risk hedging became expensive and unnecessary. At the same time, the government announced rupees 17.2 lakh crore in gross market borrowing. This is where the deeper damage begins. When the government absorbs that much credit, the private sector is crowded out. Small businesses pay higher interest. Entrepreneurs delay expansion. Job creation slows. Capital fled. Credit tightened. And India sent a clear signal. Markets are now a revenue source, not a growth partner. For over a decade, the promise was simple. Make in India. Build factories. Become the next manufacturing powerhouse. That experiment failed. Manufacturing remained stuck below 18% of GDP. Global supply chains moved to Vietnam, Bangladesh, Mexico. This budget quietly accepts that reality and pivots hard. The new bet? Services. Data centers. Digital infrastructure, a tax holiday for data centers until 2047, a target of 10% of global service exports. But here's the risk. India doesn't manufacture advanced chips. Data centers rely entirely on imported hardware. Global tech firms face legal barriers storing sensitive data in India. Jobs from data centers are minimal. Artificial intelligence is already automating service sector employment. At the same time, farmers were barely mentioned. Middle-class tax slabs were frozen, creating a stealth tax via inflation. Social spending quietly undershot headline promises. Youth employment schemes were slashed. Defense spending rose, but not enough to modernize. India is attempting to leapfrog from farms directly to server rooms, skipping the factory floor entirely. That's not just an economic gamble, it's a civilizational one. The market crash was structural, not emotional. STT hikes signaled hostility to capital and liquidity. Massive government borrowing risks choking private investment. Make in India has been quietly abandoned. The pivot to services is high risk and job light. Farmers and the middle class saw little real relief. India is betting growth on a narrow, elite-driven model. Lower costs for select critical medicines. There is a clear fiscal discipline focus. There is a long-term push toward digital infrastructure. This is an attempt to position India in global services trade. However, there are market-unfriendly tax changes. The risk of capital flight has increased. Private sector credit is being squeezed. There is no meaningful relief for rural or middle-class citizens. Job creation has largely been ignored. We are seeing an over-reliance on services amid artificial intelligence disruption. There is strategic leapfrogging without safety nets. This budget is future-ready only if the future unfolds exactly as planned. If it doesn't, there is no fallback. This Sunday isn't just a bad market day. It may have been the moment India realized the roadmap leads to a cliff, and the parachute is untested. Stay safe. Stay curious. Happy new thinking.